put your phone or device aside and immerse yourself in this audio story. Perfect for listening on the move, while relaxing, or for bedtime listening. We release new stories daily, so make sure to like and subscribe to not miss out. This story is based on true events. The Shadow Ledger. In the gleaming towers of global banking, where trillions flow through digital veins every second, there exists a shadow ledger. Transactions that never appear in annual reports. Money that whispers of things no shareholder should ever know. Between 2006 and 2010, one of the world's most prestigious banks became something else entirely. A washing machine for the blood money of Mexican drug cartels. This is the story of how HSBC, a financial institution trusted by millions, quietly processed $881 billion in suspect transactions, laundering at least $881 million for the Sinaloa and Norte del Valle cartels, while bodies piled up in the streets of Mexico. What you're about to hear is not fiction. It's the documented truth of how one of banking's oldest names became the financial backbone of mass murder. The Hong Kong and Shanghai Banking Corporation, HSBC, was founded in 1865 to finance trade between East and West. By the early 2000s, it had transformed into a global behemoth, operating in 85 countries, with assets exceeding $2.5 trillion. Its London headquarters rose like a monument to financial respectability, its executive suites populated by men in bespoke suits, who spoke the careful language of compliance and shareholder value. But in the bank's Mexican subsidiary, HSBC Mexico, a different kind of business was being conducted in the shadows, the kind where questions weren't asked, where due diligence became a performance rather than a practice, and where the color of money mattered far less than its volume. To understand this dark business story, you must first understand the machinery of money laundering. When drug cartels move billions in cash, stacks of blood-stained bills accumulated from street corners in Los Angeles, Chicago, and New York, they face a fundamental problem. Dirty money is worthless until it's clean. You can't buy a yacht with duffel bags of 20s. You can't wire drug proceeds to purchase legitimate businesses. You need a bank. Not just any bank, but one willing to look the other way while your cash enters the legitimate financial system, gets layered through complex transactions, and emerges as seemingly legal wealth on the other side. For the Sinaloa cartel, led by the infamous Joaquin El Chapo Guzman, and the Norte del Valle cartel, HSBC became that bank. The scheme was breathtaking in its simplicity and scale. HSBC Mexico designed special cash deposit boxes, literally custom-built to fit the exact dimensions of cartel cash deposits, making it easier for drug traffickers to slide their money through the teller windows. Think about that for a moment. A major international bank engineering its physical infrastructure to accommodate the geometric needs of organized crime. Between 2007 and 2008 alone, HSBC Mexico's cajas, these special boxes, accepted $15 billion in cash deposits from Mexican currency exchange houses known as casas de cambio. In a country where the average citizen struggles to survive, where did billions in cash originate? The bank didn't ask. Or more precisely, it asked and then deliberately ignored the answers that came back, soaked in blood. But the casas de cambio were just the first layer of a vast corporate scandal that reached far beyond Mexico's borders. HSBC's global compliance system, the supposed safeguard against exactly this kind of financial crime, had been systematically dismantled by executives chasing growth and profit. Internal warnings were ignored. Red flags were dismissed as obstacles to business expansion. When HSBC's own anti-money laundering director raised concerns about Mexican operations in 2008, his warnings vanished into the bureaucratic void. The bank's risk management became a theater of paperwork, forms filled out and filed away. compliance boxes checked with no one actually reading what the boxes contained. Meanwhile, billions continued to flow. Here's where the business thriller deepens into something darker still. HSBC wasn't merely negligent, it was willfully blind, and that blindness was profitable. The bank's Mexican operation generated enormous fees from processing these transactions. Every deposit, every transfer, every movement of cartel money through HSBC's systems enriched the bank's bottom line. Senior executives in London received reports detailing Mexico's explosive growth in cash transactions, and they celebrated it. Bonuses were paid. Promotions were granted. Shareholders received dividends partially funded by the blood economy of the drug war. The machine of modern banking had found a way to profit from death while maintaining the appearance of respectability. But then came the moment when the shadows could no longer contain the truth. In 2010, a young HSBC compliance officer in Delaware made a discovery that would crack open this financial mystery. While reviewing transaction records, she noticed something impossible to explain. Massive wire transfers moving between HSBC Mexico and accounts linked to known narcotics traffickers. Not suspicious accounts, not possibly criminal accounts. Accounts that U.S. law enforcement had already identified as belonging to cartel operatives. She flagged the transactions. She filed reports. She waited for the system to respond. Instead, she watched as her reports were quietly buried by her superiors. That's when she understood. This wasn't a failure of the system. This was the system. The compliance infrastructure itself had been corrupted from within, transformed into a mechanism for enabling crime rather than preventing it. The compliance officer's discovery triggered something that HSBC's executives had long feared: attention from American regulators. The U.S. Senate Permanent Subcommittee on Investigations, led by Senator Carl Levin, launched an inquiry that would eventually expose the full scope of HSBC's corruption. What they found was a cathedral of crime hidden inside a temple of finance. Between 2006 and 2010, HSBC had processed $881 billion transactions for Mexican and Colombian banks. Money flowing through the American financial system despite obvious red flags. The bank had failed to monitor $670 billion in wire transfers and $9.4 billion in cash transactions. It had violated the Bank Secrecy Act, the Trading with the Enemy Act, and virtually every anti-money laundering regulation designed to prevent exactly this kind of criminality. But the Mexican cartels weren't HSBC's only dark clients. Investigators discovered that the bank had also processed transactions for customers in Iran, Libya, Sudan, Burma, and Cuba, countries under strict U.S. sanctions, where American financial institutions are explicitly forbidden from doing business. HSBC had deliberately stripped information from wire transfers to hide the Iranian origins of hundreds of millions in prohibited transactions. They'd helped the Iranian government and Iranian banks move money through the U.S. financial system, while international sanctions were designed to choke off exactly this kind of access. The pattern was clear. Wherever there was money to be made, no matter how blood-soaked, no matter how illegal, HSBC found a way to profit. The psychological insight here cuts to the heart of corporate greed and the danger of unchecked ambition. How does a bank founded in 1865, built on principles of trust and stability, become a money laundering operation for murderers? The answer lies in the quiet erosion of ethics that occurs when profit becomes the only measure of success. Each compromised transaction creates a new baseline. Each ignored warning makes the next warning easier to dismiss. Each quarter's earnings report that beats expectations rewards the very executives who dismantled the safeguards. The descent into darkness isn't a single decision. It's 1,000 small choices, each one justified by market pressures and competitive necessity. until the institution itself becomes unrecognizable from its founding principles. By 2012, the evidence was overwhelming and undeniable. The Senate investigation revealed internal HSBC emails that were damning in their casualness. Executives joking about regulatory concerns, compliance officers expressing resignation about the futility of their jobs, risk managers openly stating that anti-money laundering controls were window dressing for regulators. One email sent by HSBC's head of compliance for the Americas included the line, "We are not equipped to maintain an effective AML program across the sprawling HSBC empire." They knew. They always knew. The question was never competence, it was choice, and they chose profit. Then came the revelation that transformed this story from a business scandal into a commentary on justice itself. In December 2012, the U.S. Department of Justice announced its response to HSBC's crimes: a deferred prosecution agreement and a $1.92 billion fine. It was, at the time, the largest penalty ever imposed on a bank for money laundering violations. The headlines celebrated it as accountability. But look closer at the numbers, and the dark truth emerges. $1.92 billion sounds enormous until you realize it represented approximately 5 weeks of HSBC's income at the time. 5 weeks. For a decade of laundering money for organizations that murdered tens of thousands of people during Mexico's drug war. The bank didn't collapse. Its executives didn't go to prison. No one was criminally charged. Instead, HSBC signed an agreement promising to be good in the future, paid what amounted to a rounding error from its balance sheet, and continued operating as one of the world's largest banks. Assistant Attorney General Lanny Breuer explained the Justice Department's reasoning in terms that would echo through financial history. Prosecuting HSBC could threaten the stability of the global financial system. The bank was too big to indict, too interconnected to the world economy, too important to fail. This was the hidden cost of success made visible when an institution becomes large enough, powerful enough, essential enough to the machinery of global capitalism. It also becomes immune to the consequences that would destroy any individual or smaller organization. HSBC had achieved something remarkable and terrifying. It had become too criminal to prosecute. The human cost of this corporate scandal is almost impossible to fully comprehend. During the years HSBC was processing cartel money, Mexico's drug war killed an estimated 120,000 people. Bodies hung from bridges. Mass graves appeared in the desert. Entire towns were depopulated by violence. The cartels HSBC served, particularly the Sinaloa cartel, were responsible for a substantial portion of this bloodshed. Every dollar HSBC laundered represented drugs that had been sold, territories that had been fought over, witnesses who had been silenced, and families who had been destroyed. The bank didn't pull the triggers, but it provided the financial infrastructure that made the triggers worth pulling. It transformed local violence into global profit. The deferred prosecution agreement included some reforms. HSBC agreed to install an independent monitor, overhaul its compliance systems, and strengthen its anti-money laundering controls. The bank's CEO, Stuart Gulliver, issued a public apology, stating that HSBC had fallen short of our own expectations and the expectations of our regulators. But notice the language, fallen short, as if this were merely a disappointing quarterly earnings report rather than facilitation of mass murder. The carefully crafted corporate speak revealed everything. Even in apology, the bank couldn't bring itself to speak plainly about what it had done. It had become an accomplice to industrial-scale death, and the best it could muster was regret for falling short of expectations. What business lessons emerge from this financial mystery? First, understand that compliance is not a department, It's a culture, and culture flows from leadership. When executives prioritize growth over ethics, when they reward risk-taking while punishing caution, when they treat regulatory requirements as obstacles rather than guardrails, the organization inevitably drifts toward darkness. Second, recognize that size creates its own moral hazard. The larger and more systemically important an institution becomes, the more it can externalize the consequences of its actions onto society while internalizing the profits. This is not capitalism. It's extraction dressed in capitalism's language. Third, never forget that money is not neutral. Every transaction carries the moral weight of its origins. When you process $1 billion without asking where it came from, you're not just doing business. You're making a choice about what you're willing to enable for profit. The aftermath of the HSBC settlement revealed another layer to this real-life business story. In 2016, the Independent Monitor filed a report stating that HSBC had made significant progress in reforming its compliance systems. The deferred prosecution agreement was allowed to expire without any criminal charges being filed. The threat of prosecution, such as it was, simply evaporated. HSBC's stock price, which had dipped slightly during the scandal, recovered and then soared to new highs. The market had rendered its verdict. Crime pays, especially when you're big enough that punishment threatens the system itself. But not everyone accepted this outcome quietly. Families of drug war victims filed civil lawsuits against HSBC, seeking damages for the deaths of their loved ones. These cases largely failed. Establishing direct causation between a bank's money laundering and a specific murder proved nearly impossible in court. The legal system, designed for individual crimes and personal liability, struggled to grapple with institutional evil operating at global scale. How do you prosecute a corporation that operates in 85 countries when the crime is diffused across thousands of transactions and hundreds of employees? How do you assign blame when the chain of causation runs through boardrooms in London, branches in Mexico City, and crime scenes in Juarez? The law, it turned out, had not evolved to handle this new species of criminality, the too-big-to-jail bank. The strategic lessons from HSBC's dark journey extend beyond compliance. Consider the psychology of institutional corruption. At each level of the organization, individuals rationalized their participation in different ways. The teller accepting the cash deposits told herself she was just doing her job. The branch manager approving suspicious accounts told himself he was meeting his targets. The compliance officer filing reports that were never read told herself she'd done her duty by documenting concerns. The senior executive in London reviewing Mexico's profitability told himself he couldn't be expected to know the details of every transaction. Each layer of rationalization, each degree of separation, made the crime possible. This is how organizations commit acts that no individual in them would commit alone, through the diffusion of responsibility across hierarchies so vast that everyone can claim to be merely following orders, merely doing business, merely one small part of a machine too large to comprehend. The wider implications ripple through global finance to this day. The HSBC case established a precedent. Systemically important financial institutions operate under different rules than everyone else. This knowledge has shaped behavior across the banking industry. If the consequences of crime are merely financial, and if those financial penalties are small relative to the profits generated by the crime, then crime becomes a rational business decision. This is the hidden machinery behind wealth, the ability of large institutions to price in misconduct as a cost of doing business, to treat billion-dollar fines as line items in a budget rather than deterrents to behavior. The rise and fall promised by the headline never came. Only the rise, interrupted briefly by an affordable speed bump. Today, HSBC continues to operate as one of the world's largest banks, managing over $3 trillion in assets. Its executives have changed. Its compliance systems have been overhauled, at least on paper. It sponsors sporting events and cultural institutions. Its advertisements speak of trust, reliability, and partnership. To the average customer, HSBC is just another bank. Its history of laundering cartel money fading into the background noise of a business cycle that treats billion-dollar scandals as forgettable footnotes. But the dead remain dead. The families destroyed by the drug trade remain destroyed. And the fundamental architecture of global finance, the structure that allowed this to happen and then prevented meaningful accountability, remains unchanged. The real wealth and power lesson here is uncomfortable. In modern capitalism, size grants immunity. Once an institution becomes sufficiently large and interconnected, it transitions from being subject to the system to being a component of the system itself. At that point, its survival becomes a public interest that supersedes justice. This is not a conspiracy. It's an emergent property of complex systems, a logical consequence of allowing private institutions to become so large that their failure threatens public welfare. HSBC didn't need to be protected because it was beloved or because regulators were corrupt. It was protected because letting it collapse would have harmed millions of innocent people who had nothing to do with its crimes. The hostage in this scenario was the global economy itself. What should entrepreneurs and business leaders take from this billionaire secrets revelation? First, that exponential growth without ethical constraints leads to catastrophic outcomes, even if those outcomes are delayed or dispersed. Second, that compliance is expensive and resistance to regulation is profitable, right up until the moment the system fails spectacularly. Third, that reputation is built over decades and destroyed in moments, but apparently can be rebuilt with enough money and time if you survive the initial scandal. Fourth, and perhaps most critically, that the market does not inherently punish unethical behavior. If that behavior is profitable and the institution is large enough to weather the consequences, the invisible hand that supposedly guides capitalism toward optimal outcomes is remarkably blind to certain forms of evil. The stock market secrets revealed by HSBC's case are equally dark. Despite the scandal, despite the fine, despite the global publicity and governmental investigations, HSBC's stock recovered fully within months of the settlement. Investors calculated, correctly, that the bank's fundamentals were unaffected by its criminal behavior. It still had millions of customers, still controlled trillions in assets, still operated in 85 countries, and still generated billions in annual profits. The criminality was priced in and then dismissed as non-material to future performance. This reveals a truth about modern equity markets. They are remarkably efficient at pricing risk and opportunity, but often terrible at pricing morality. The market doesn't care how you make money, only that you make it predictably and at scale. Looking at this business scandal documentary from a regulatory perspective reveals another failure: the fragmentation of oversight. HSBC operated across dozens of jurisdictions, each with its own regulatory framework. What was illegal in the United States was sometimes legal elsewhere. What was vigorously enforced in one country was ignored in another. The bank exploited these gaps, moving money through the spaces between regulatory regimes. This is the arbitrage of ethics, finding the jurisdictions where oversight is weakest, where enforcement is most lenient, where questions are least likely to be asked. As long as global finance operates across borders, while regulation remains largely national, these gaps will exist, and institutions with the sophistication and resources to exploit them will continue to do so. The money and greed that drove this story operated on a scale that defies individual comprehension. $881 billion in suspect transactions is not a number humans can intuitively grasp. Try to imagine $1 billion in cash. It would weigh approximately 10 tons and fill a room. Now multiply that by 881. That's the magnitude of money that HSBC moved without adequate oversight. Each dollar represented a transaction in the real economy. Drugs sold, lives ruined, violence funded. But to the bank, these were just numbers on screens, bits in databases, entries in ledgers that generated fees and bonuses and shareholder value. The abstraction of money allowed the abstraction of morality. When wealth becomes pure data, divorced from its physical reality and human consequences, it becomes remarkably easy to process without conscience. In the years since the settlement, other banks have faced similar scandals. Deutsche Bank, Standard Chartered, JP Morgan Chase, and others have all paid billions in fines for money laundering violations, sanctions evasion, and related crimes. The pattern repeats. Investigation, settlement, fine, reform, recovery. No criminal prosecutions of senior executives. No fundamental restructuring of institutions too large to jail. No systematic changes to the global financial architecture that makes these crimes possible and profitable. The HSBC case wasn't an aberration. It was a preview, a demonstration of how modern financial crime operates and how modern justice systems fail to address it. Each new scandal confirms the same lesson. At sufficient scale, crime becomes policy, and accountability becomes negotiable. The final entrepreneurship secrets hiding in this story are the darkest of all. Success in modern business often requires growth at any cost, expansion into markets regardless of local conditions, and revenue generation that prioritizes quarterly results over long-term sustainability or ethics. HSBC's Mexican operation grew explosively because executives in London demanded growth. The compliance failures happened because compliance was seen as a cost center rather than a value creator. The laundering occurred because stopping it would have meant sacrificing profit. At every decision point, the incentive structures rewarded the wrong choices. This is the trap of shareholder capitalism, taken to its logical extreme. When the only obligation is maximizing returns, every other consideration, including basic morality, becomes optional. So where does this leave us, standing in the present with full knowledge of HSBC's dark past? The bank operates today, much as it did before the scandal, just with better paperwork. The cartels it served have evolved, fragmented, or been replaced by new organizations. The regulators who investigated have moved on to other cases. The victims remain victims, their losses uncompensated and largely forgotten, except by those who loved them. And the system that enabled it all, the global financial infrastructure that allows money to flow freely while accountability remains stubbornly local, continues to function exactly as designed. The scandal revealed how the machine works, but it didn't break the machine. It barely scratched it. This is the business crime that defines our era. Not the crude thefts of earlier generations, but sophisticated institutional failures that operate in plain sight while remaining somehow invisible to meaningful consequences. HSBC didn't launder money in secret. It did so through its normal business operations, using its standard systems, with knowledge permeating through multiple levels of management. The crime was hidden in the vast scale of legitimate transactions, camouflaged by the sheer volume of money moving through the global banking system every day. This is the perfect crime for the modern age, one too large to fully prosecute, too complex to fully understand, and too interconnected to the system itself to fully punish. The chilling conclusion returns us to where we began, in the gleaming towers of global banking, where trillions flow and secrets accumulate in the spaces between transactions. HSBC's story is not a cautionary tale, because the caution has no teeth. The bank survived, thrived, and continues to profit. It's a revelation of how modern capitalism actually functions beneath its polished surface, where money from any source is welcome, as long as there's enough of it, where consequences are for the small and prosecution is for the weak, and where the price of participation in mass death is a fine large enough to make headlines, but small enough to be paid from petty cash. The dark truth hidden in HSBC's shadow ledger is this. We know how the system works now, we've seen its machinery exposed, and collectively we've decided that's acceptable. The real scandal isn't that it happened. The real scandal is that it's still happening, just with better compliance reports and more carefully worded press releases. The shadow ledger never closed. It just got better at hiding. Subscribe and listen to our next story below.